Hey, hey, hey! It's the first ever real estate marathon. I'm your host, Takhar. I hope you guys are enjoying what's happening on this marathon. I have Geoff Warren coming on. As I mentioned, we can make a lot of money, we can create a lot of wealth, but if we don't figure out how to keep it and keep majority of it, keep most of it, what good is it for us? And that's why I brought my boy on, Geoff Warren, Mr. Accountant. How you doing
good,
today?
Good, my man. How you doing?
Good. Look, you heard me do the intro, Geoff. We need to find out what are some tax advantages for real estate investors. So let's get into it. I mean, there's a lot of questions I have for you as well, but I kind of want to start off high level. Like, what are some tax strategies that investors can take advantage of?
Okay, well, let's talk about a rental property and what you're going to be looking at here. You've got rental properties that you own personally. So if you're owning that personally in your own name, that's going to fall into your personal tax return, right? So that's your T1 return. That gets divided into the percentage ownership. So let's say we're looking at a husband-wife scenario owning a T1 or a rental property.
Okay.
Falls into that tax return according to that. I always preach simplicity when you're looking at a rental property.
Okay,
right?
I love that because you're going to bring it down for our investors right now in terms of how can we make this simple.
Totally.
Because some things with accounting are like,
well,
not simple.
yeah, no, exactly.
They should be because it's math. 1 + 1 = kind of 2, but it doesn't always equal 2.
Does it equal 2?
Well, see, exactly.
So exactly.
Yeah.
So you know, simplicity. When I say like, let's segregate your expenses from your personal finances,
Okay.
right? So have that dedicated credit card that's going to be for your rental property alone.
Oh, I like that.
Have that automated bank account where your expenses are coming out, personal property taxes.
So hang on one sec, Geoff. I want to just slow it down, okay?
Yeah.
And I appreciate it because you know this, you do this a lot, but I want to slow it down even for myself because I'm going to learn a lot as well. I'm investing into a property 123 Main Street.
Yep.
So should 123 Main Street have its own account?
Absolutely.
Okay, go. Continue.
Absolutely. So 123 Main Street's got its own bank account.
Make it nice and simple.
Like making it nice and automated, so get that property tax coming out of the account directly, right? Get the utility payments, if the tenant's covering them, great, they pay them. If you're paying them, get them out that way on their own, right? Ultimately, what we do is we look at the net number, and that's what comes out onto your personal tax return. That gets taxed at your marginal rate. That might be advantageous if, let's say, wife is in a lower bracket or husband's in a lower bracket, but ultimately that's where it goes, and there's not a lot of structure around that. You got to look at things of, how do you depreciate that property, right? Because there is CCA available to you, but there could be adverse tax impacts.
CCA?
Capital cost amortization, so that's where you depreciate the property itself, and you get to depreciate the building, right? Or any subsequent investment. Let's say you put a new roof on that building, then you're looking at, you can take the depreciation on that, right?
Nice.
But there's bad impacts that can happen with that depreciation as well. So you get the short-term gain, but potentially a long-term consequence, which is why you want to be talking to a professional and make sure that you are sort of structuring your rental property properly.
And to that point, at any time, send us an email, info@reccanada.com. We'll make sure we get you in touch with Geoff and his team and make sure that you're set up properly. You continue because I also want to talk about how to get set up properly as well. Go.
That's a good plug there, Jess. Thanks, man. So anyway, so that's the personal side for a rental property, right? Then we flip it and we can look at corporately held property, right? And corporations, there's pros and cons to a corporation, right? So let's step back from accounting. One is with a corporation, you're automatically segregating your assets, right? So, you set up number company 1234 Ontario Inc. It is holding 123 Main Street as the property within it. Well, how is that taxed, right? Ultimately, there's tests that take place, but 123 Main Street's probably not going to be considered active business, okay?
Right.
It's going to be considered a passive form of income, so that means that you're going to get taxed around 48% within the corporation. Once you dividend the income out, then it goes down to 22%, but it's a way that you're going to hold it, but you're not getting that beautiful 15.5% that you're looking at with an active business.
So how does that work? So within a real estate investment, can I get the 15.2? Can I get that? Or
15.5, you can if you have 5 employees working within that company on a full-time basis.
And who's considered an employee?
It's got to be someone that's going to be working at the fair market value of that thing. So if you're looking at a property manager, or if you are looking at someone that's looking at vetting tenants or whatnot, ultimately that's not something we're seeing a lot of our.
So it can't be my investors. 2 kids, wife, and my.
No,
okay.
I'm
just making sure. Just making sure.
Yeah.
Okay.
But ultimately, so there's when we're looking at corporately held properties, if you're in that model where you're a serious investor and you've got all these employees and you've got multiple buildings and you've got something that's going to sustain that,
right.
it's a really great piece, right? But if not, then you're just looking at sort of a passive holding. But what you do get is that benefit of segregated assets, right? You don't ever have to worry if someone slips on a porch that they're going to be coming after your family home down the road or any of the assets that you've acquired personally.
In terms of setting it up under a corporation, are you saying that the real only benefit is if somebody slips and falls, like other than if you don't have the 5 employees, because you're not going to be able to really take advantage of that 15.5%?
Yeah, I mean, it also segregates. Okay,
right.
Think of your personal tax return, right?
Okay.
I don't like a very busy, ugly, complicated personal tax return.
Okay.
It gives more things for the government to really be looking at. If you've got 5 rental properties within your personal tax return, there's a lot happening in that T1, right? By moving it into a corporate structure,
right.
Well, all of a sudden now you're moving it out and see you get a T4 or you get a dividend from that corporation. That's all that flows into your personal tax return. So there's no sort of set one to sort of right. Every situation is obviously a little different. That's why I want people to email us so we put them in touch with you, because this is definitely not what we do here at REC Canada. We get you in touch with the right people, and that's why I want to make sure I do that. But continue. Well, 100%. I mean, for example, what is your marginal tax rate? Are you someone that's earning $500,000 a year, at which point any net rental income that you're going to have, right? You've got that simple structure, rent comes into your separate account, you record your expenses. If you're in a high marginal rate, all of a sudden you're going to pay a lot of tax on that net rental income, right? Well, then maybe the corporate structure is for you. You can move it in, you can defer it, and you kind of simplify what is going to be a bigger tax return. So it's what we do is we look at the overall circumstances that a potential investor is looking at, and then we dovetail the solution to what best serves them.
What best serves them. Now, you're an investor yourself, and that's why I really wanted to partner up. You're actually the accountant of our Director of Sales and Marketing, Laura Stewart, and her husband. And so, I mean, the introduction, they are obviously working within our family, and this is just Jazz going on a slight little tangent. If you know somebody who's watching, if you're watching or listening right now and you know a great electrician or a great plumber, please let us know. And we're going to be talking about that in detail in our next segment with Mr. Tyler Walburn. He's the director of our REC Concierge, Real Estate Concierge Services. And Geoff is part of that concierge service where Tyler will put you in touch with Geoff and his team. You being an investor in real estate, what are some other things that have come up from an accounting perspective?
So, I mean, I just had a tenant moving in this morning, for example, and we've been sort of dealing with sort of that overall transition, 15th of the month coming in and all of that. I mean, let's say I've been personally looking at one of the first properties we purchased individually ourselves, and it didn't go into a corporate structure, right? And ultimately, when we started looking at, how do we transition? When you start doing your housekeeping and you're saying, maybe we're going to start shifting this property into it. We all of a sudden got hit with the consequences of land transfer tax. Now, there's obviously gains on that property.
Welcome to Ontario.
I know,
welcome to Toronto.
Yeah, exactly.
We know those taxes.
And so just moving that personally held property into a corporate structure will trigger. You're saying, well, I own it personally. I own the corporation. So isn't that not just going to be a transfer? Well, one, there's accrued gains that you're going to have to deal with. We've got some tax tricks to work with that. But even doing a transfer from yourself personally into a corporation, you have to be aware of that land transfer tax. And that's where you're saying, I've got an overall plan here. How can I roll that in and make it work? What is the consequence? And then what's the benefit that I'm going to see out of that, right? And ultimately, is that going to be a worthwhile decision? And that's something we do with clients all the time. We say, this is the circumstances we're in now. This is a potential structure we're looking at. What's the benefits? What's the consequences? How are we going to get ourselves there? And that's kind of the solutions we have. It's never one size fits all. Yeah. But there is a solution for you. That's for sure.
I love what you said. It's probably the best thing that I heard all day today. Yeah. Jeff. It was tax tricks. It was the word tax tricks that got me. Whoa. Okay. Anyways, so now I actually have some personal questions as well. Okay. Let's just say that the real estate marathon, today we were charging people $49 or $99, whatever the number is.
Yeah.
Can an investor write that off?
Like if you're
I know not one size fits all, but I'm just trying to, because I have a couple of these questions that come to me all the time from my clients.
Yeah, for sure. So you've got to be looking at write-offs related to the business should be tied into, does it help you earn that rental income? Right?
Okay.
And is it associated with it? So it could be a form of professional development, yourself as a landlord.
Yes.
And you're looking at it as this really is an expense that is related to my operations of my rental property.
Yes.
If that's the case, then go for it. You can try and write that off.
Right, okay. And now, so I own a home and I'm getting a line of credit, and that line of credit, I'm going to be purchasing a pre-construction condo. Can I write off the interest on that line of credit?
Yeah, so you want
that's a definite one.
You want it, and you want to segregate that. You know that the important thing is maintaining really clear records, right? So when I talk simplicity, you've got that segregated bank account, you've got that dedicated credit card. You really want to make sure that you're maintaining extremely clear records. If you're pulling a line of credit for investment purposes, all right, look at what your existing mortgage was, look at what that line of credit was, keep it segregated so that you know that if you invested that $400K to put into that down payment for whatever property it is, that what the interest portion of that is a deductible expense against that rental property.
That rental property.
But trace it and keep your records. And you want to hold on to those records for 7 years so that the CRA ever does come and ask, you're ready to speak to it and be like, no, this is where we go, this is the calculation.
Now, is there software and apps now that you know of? Maybe just some quick little tips, and like just to give some value without you emailing info@reccanada.com. I don't know why you wouldn't email info@reccanada.com. I've only said it 113 times today, and I want to get you in touch with the experts. That's why I keep on saying it, guys, because I'm not the expert when it comes to accounting. I'm not the expert when it comes to RSP investing. I'm not the legal expert. We are going to have a couple of lawyers coming up, one talking about all things assignment, and then we have the lawyer that handles everything at the landlord-tenant board and the new Bill 184. Make sure you stick around. The marathon continues. Now, Geoff, back to you, my man. How do we, like, what are some other tips for investors, maybe from a personal perspective, because you are an investor? When was that first investment property you got, and how did you or your partner get over that fear?
Okay, so it was deadly scary. The first property. I lived in a really small apartment. Okay. My wife, when everyone's looking to buy a first family home, my wife and I are like, no, we're actually going to buy a triplex, and we're going to deal with it this way. And it was a gong show. And what it forced me to do was start to develop things like, I'm a big user of Excel. It's an accountant's kind of core tool, right? So I developed a series of templates that allow me to sort of look at how I pull in my expenses. If you use that dedicated credit card, it's really easy to download your statements.
So I do that from a business perspective. I use this card for this. I try my best. Sometimes I slip up. But so I'm glad that you use that strategy. Continue.
But for sure. But in addition, tools have gotten substantially better in terms of like, if you want to go the QuickBooks Online, the Xero route, you can set
what can I use? I don't have a computer. A lot of my insiders know, my team know, I don't own a computer, I don't touch a computer. I do everything from this bad boy right here. What apps? Is there one or two apps? Does QuickBooks have an app or something?
It sure does.
Okay, good.
And then I also use Receipt Bank a lot. So now whenever a contractor comes and they're doing something, they give me a receipt, I take a picture of it, automatically upload it to the cloud. When I get to the end of the year, it's a simple consolidation. That's not for everyone. I've got lots of clients that are very into their paper. They're not holding on to the paper. Fine. Set up a dedicated folder where you slot receipts, right? I say at the end of the week, grab a glass of wine, a beer, whatever you're doing, and spend half an hour slotting receipts. Stay on top of it. One of the worst things you can do is wait till 12 months from the end of the year, and then you're like, oh God, I got to talk to my accountant, right? And you get that shoebox of receipts.
I've done it.
God, that's problematic, right? So just stay on top of it. Whether you're using a dedicated software, you're super digital, you're taking pictures, you're putting it up to the cloud, or whether you are just keeping your receipts and slotting them away, if you stay on top of it, you're organized and you're tracing through all of these various expenses, and you're talking to someone that's going to help you make sure that you're staying on top of the right details.
Right.
Trust me, rental properties are a dream.
So you were scared the first time, though?
I was terrified.
So what got you over?
Well, I got 4 now, though.
I know. That's what I'm saying.
So it was a push.
One of the themes of this marathon, one of the themes of all the content that I produce is everyone was scared until they did it. They were scared to buy a home. They were scared to invest into a home. They were scared to start a business. But once you did, they were scared to do a virtual marathon. But until you did it, now you got that confidence. You put in those reps, those muscles get stronger. You're at number 4. Take me back to number 1 when you were scared, and how did you get over it?
Well, you know what? So what we did was we put in a lot of work. Listen, I had to change toilets. I was like.
So you deal with the tenants and the toilets kind of thing. We try not to. We try to help our guys not do that. But okay, go. That's good. That's good.
I was Google.
But a lot of people do, man.
I was Google handyman. Listen, I know how to paint and cut a beautiful corner now.
Okay,
and these are the things. But you know, it just became a confidence. Like you will see the benefit of an investment like that, and it becomes addictive, right? Because all
it's the best drug in the world.
You know, and you just feel like even when you're not working, someone's working for you. Someone's paying that mortgage down for you, and so it just became something that I became confident in as we saw, and I mean it became personal growth. You learn to read people. You learn to understand who's going to be a good tenant for you. And you know, knock on wood, but I've never really had any real issues.
Major problems.
And it's been just a solid piece that I take a ton of pride in.
And you're passively creating that wealth over time.
Exactly.
Now you've been doing this for a decade. I know it looks like you probably started when he was 1 when he was doing this stuff, but it's not going to be started. You've been doing this for a decade, so you bring a wealth of experience. I'm so happy to have you part of our service providers, and as I mentioned, I'm going to be talking about that with Tyler, how those recommendations happen and how we vet people and how we have to actually vet out Geoff's team. Geoff, what areas do you service? Like, is this a provincial thing, a city thing? Like, how does that look? Like, if I have people in Vancouver, I have people in Quebec. I saw a message come in. I think it was Bobby Pume. I think someone said Quebec, right, Bobby? I think and so what areas do you service? So because there's a lot of people watching right across the world, mostly focused in Canada. What areas do you service?
Yeah, so I service the Canadian market through and through, East Coast to West Coast.
Okay.
Right? And obviously, you know, we've got a large subset of our clients that are in Toronto, west end of the city. One of the things I've noticed with the whole COVID situation is, God, we are extremely efficient when we don't have clients walking in the office all the time.
It's true.
You know, we've developed templates, intake forms, ways that, you know, you don't even have to step in my office. We can set up a Zoom call. We can hop on a phone call. And listen, I love dispensing advice and just giving sort of those practical solutions.
Lead with education.
And, well,
continue.
I guess so.
Yeah.
And so, you know, we service that. Obviously, I've got a real investment and focus on real estate. That's something that I've been working with clients for a number of years. As a small practice, I do a lot of personal tax returns as well as a lot of corporate work. And so, you know, we do have a pretty broad base.
So it's personal, corporate, and real estate, all of it, kind of.
Well, you know, and I do a lot of estate and trust work as well. So after you've died, you know, and that's a real consideration too, right? Because you might have great parents that have invested in properties. What's going to happen with that property when it goes down a generation? What's the taxable consequences with that? And the corporate structure falls into probate planning as well with your wills. So I've got a real focus on that market as well, and it's something that I'm extremely proud of doing.
I'm glad that you talked about parents, real estate going down to the kids, because we've been speaking about generational wealth, right?
Absolutely.
And this marathon would not have happened if I didn't have an accountant. And I'm not just saying that. Reason being because, damn, you can make a lot of money, you can create a lot of wealth, but if you're not keeping it, what good is it? Right? And I'm never ever telling people that try to cheat the system. We all gotta pay we gotta pay for the services that we have. But if there's a way of minimizing it, or what I'm really finding out over experience now, doing this for 15 years, you're not getting away from the CRA and getting away from paying taxes. You're just going to be able to defer them.
For sure. I mean, and pay your part. That's
exactly as we should.
In a great country, that's what we should do. Well, but at the same time, listen, let's keep as much of it in your pocket as possible. And that's always my objective. That's what I've been preaching.
Is there another tip that you might have as you for our marathoners to keep a little bit more money in our pocket? It doesn't necessarily need to come from only to an investor. It could just be from a personal perspective, but obviously accounting as whole. What's that one tip we might be able to leave our marathoners with today? And it might just be organize your stuff, guys.
I'm gonna say you kind of took the words out of my mouth, but it really does fall down to being organized, right? Because when someone comes to me with just a shoebox of receipts, I'm inherently not going to push the taxes necessarily as hard, right? Because they're not going to be in a position to defend themselves, and the last thing I want to do is try and do something that's your write-offs is very distinct. What is a good write-off? What's not a good write-off, right? But if you are good and organized, you are going to be way ahead of the game.
Even if you just learned get your shit organized, your taxes and your receipts and all that kind of stuff. That in and of itself is the tip that my boy Geoff here is leaving you with. Again, email us right now at info@reccanada.com if you just want to get some education on how to get set up, and or if you need actual personal advice right now. Geoff is your man. Get in touch with us and we'll get you in touch with Geoff. Thank you so much for being part of history.
Thanks, man.
I appreciate you. I appreciate you coming here and doing it live. I knew we might have done it through Zoom, but I told you what we're doing. You're like, I'm there, and I appreciate it.
I'm really happy to be here. This was a blast.
Yeah?
Right? And I was
Awesome.
terrified.
Like our arena
now
or
I feel
what?
good. Now I feel
I
good.
know, and now you want to go for another 20, 30 minutes. I know how it is. I do a great job.
Yeah, you do.
Thank you. I appreciate you. Thank you so much.